Spot trading and futures trading. A spot market, also known as a cash market or physical market, is a financial marketplace where assets or securities are traded for immediate delivery and payment. In a spot market, the price of an asset is determined by the current market conditions, which include factors such as supply and demand, news, and economic indicators. This price, referred to as the spot price, reflects the immediate value of the asset being traded. Spot markets exist for various types of assets, including commodities, example, gold, oil, and agricultural products, currencies, example, foreign exchange or forex, and securities, example of stocks and bonds. While spot markets are primarily used for immediate transactions, they also serve as a reference point for determining the prices in other markets, such as futures and options markets. Price determination. The spot price of an asset is determined by various factors such as supply, demand, news, and economic indicators. In a spot market, the price reflects the current market value of the asset, and it can change constantly throughout the trading day. Order placement. Buyers and sellers place their orders in the market either through a broker or an electronic trading platform. Orders can be market orders, which are executed immediately at the best available price, or limit orders, which specify a maximum or minimum price at which the buyer or seller is willing to transact. Order matching. Once orders are placed, they are matched in the trading system based on the best available prices. When a buyer's bid price matches a seller's ask price, a trade occurs, and the transaction is executed at the agreed-upon price. Settlement. After a trade is executed, the buyer and seller proceed with the settlement process. Settlement typically involves the transfer of the asset and the corresponding payment, which usually occurs within a short period, such as 1 or 2 business days. The specific settlement period depends on the asset type and market conventions. Clearing. In some cases, a clearinghouse or clearing firm acts as an intermediary between the buyer and seller. Here are some examples of spot markets across different asset classes. Foreign exchange and forex market. The forex market is one of the largest and most liquid spot markets globally, where participants trade currencies such as US dollars, euros, Japanese yen, and British pounds. Transactions in this market typically involve the immediate exchange of one currency for another, with the goal of meeting immediate payment obligations or capitalizing on short-term fluctuations in exchange rates. Equity market. In the equity market, shares of publicly traded companies are bought and sold on stock exchanges like the New York Stock Exchange, NYSE, and the NASDAQ. These transactions involve the immediate transfer of ownership and payment, making them spot market transactions. Commodity markets. Spot markets for commodities involve the immediate purchase and sale of physical commodities like gold, silver, oil, and agricultural products. Participants in these markets may include producers, consumers, and speculators. For instance, the London Bullion Market Association, LBMA, facilitates the trading of gold and silver on a spot basis, while physical oil is traded in spot markets such as the Rotterdam market in the Netherlands. Cryptocurrency markets. Cryptocurrency exchanges like Coinbase, Binance, and Kraken provide platforms for trading digital currencies such as Bitcoin, Ethereum, and Litecoin on a spot basis. Participants in these markets exchange cryptocurrencies for other digital or fiat currencies at current market prices, with transactions typically settled immediately or within a short time frame. Bond market, a market for trading debt securities, such as government bonds, corporate bonds, and municipal bonds. Bonds are bought and sold at their current market value, which includes the face value of the bond and any accrued interest. Transactions in the bond market can occur on exchanges or through OTC trading. Over-the-counter, OTC, trading. OTC trading refers to the process of buying and selling financial instruments outside of formal exchanges, such as stock exchanges or futures exchanges. In OTC markets, transactions are conducted directly between the buyer and seller, often through a network of dealers or brokers. OTC trading is common in various financial markets, including currencies, forex, bonds, derivatives, and even some stocks not listed on major exchanges. Relationship between spot market and OTC trading. While spot markets involve the immediate exchange of assets, OTC trading refers to the venue or mechanism through which these transactions occur. In other words, OTC trading can be a way of executing spot market transactions. For example, in the foreign exchange market of forex, most currency transactions are both spot transactions and OTC trades. They are spot transactions because currencies are exchanged at their current market prices for immediate delivery, and they are OTC trades because the transactions happen directly between counterparties, such as banks and financial institutions, without going through a centralized exchange. Spot markets and futures markets are two distinct types of financial markets that serve different purposes and involve different types of transactions. Here are the main differences between spot markets and futures markets. In contrast to futures markets, where contracts for future delivery of assets are traded, spot markets emphasize the immediate exchange of assets. This makes them particularly important for businesses and individuals who need to buy or sell assets quickly and are less concerned with hedging or speculating on future price movements. Futures trading is a financial activity in which participants buy and sell contracts, called futures contracts, that represent an agreement to buy or sell an underlying asset at a specified price on a predetermined future date. The underlying assets can include commodities, example agricultural products, metals, or energy resources, financial instruments, example stocks, bonds, or currencies, or indices, example, stock market indices or interest rate indices. Futures trading enables participants, such as traders, investors, and businesses, to manage risk and speculate on the future price movements of these assets. The main participants in futures markets are hedgers, who seek to reduce the risk of adverse price movements in the underlying asset, and speculators, who aim to profit from those price movements. Futures contracts are standardized and traded on futures exchanges, which provide a transparent, regulated marketplace for buyers and sellers to transact. Some popular futures exchanges include the Chicago Mercantile Exchange, CME, the Intercontinental Exchange, ICE, and the Euronext. Futures trading can be advantageous for several reasons. Hedging: it allows businesses and investors to protect themselves against adverse price movements in the underlying asset, thus reducing risk. Leverage: futures contracts require only a small initial margin, or deposit, compared to the full value of the contract, allowing participants to gain significant exposure to price movements with relatively low upfront capital. Liquidity: futures markets generally have high liquidity, which means that participants can easily enter and exit positions without causing significant price fluctuations. Diversification: trading in a variety of futures contracts can help investors diversify their portfolios, spreading risk across different asset classes. Price discovery: the futures market facilitates the efficient price discovery process, reflecting the collective expectations of market participants about the future value of the underlying asset. Futures trading involves the buying and selling of standardized contracts that represent an agreement to exchange an underlying asset at a specified price on a predetermined future date. Here are some examples of futures contracts across various asset classes. Commodity futures. Crude oil futures, for example, West Texas Intermediate or Brent crude. Natural gas futures. Gold futures. Silver futures. Corn futures. Soybean futures. Wheat futures. Live cattle futures. Lean hog futures. Financial futures, such as Treasury bond futures. Treasury note futures. Eurodollar futures. Interest rate futures, for example, federal funds futures, Eurodollar futures. Stock index futures, such as S&P 500 index futures.